Houses are kind of expensive today, and having expensive houses combined with high interest rates, whoa, that creates a very ugly scenario for us buyers, not to mention the inability to gather money for the down payment. Luckily, there are programs out there that allow home buyers to buy a house with a down payment of just 3%. I mean, let's do the math. Let's suppose you have a house and that house is now worth $250,000, right? So you like this house, that's the asking price, and you are getting ready to put the down payment of 3% for this property. And then when you do the math, we're talking about a $7,500 down payment, which is a pretty reasonable number for most buyers to gather for a down payment. And if this wasn't good enough, let me tell you that these type of mortgage programs are more flexible with your credit score, allowing you to qualify for the purchase of a house with a FICO score of as little as 580. This is relatively low and realistically achievable for a lot of people. This type of mortgage sounds very wonderful, but if it was that easy, many people will be homeowners by now, right? I mean, putting a down payment of $7,500 is a very affordable amount to gather. So what are the banks hiding from us? And this is what I found out. So it turns out there are various types of mortgages with low down payments, but today we will focus on these two. So on one side, we have the conventional mortgages, right? Those that are backed by Fannie Mae and Freddie Mac. And on the other side, we have the so-called popular FHA loans, which are backed by the Federal Housing Administration. On the down payment side, conventional mortgages request a minimum of 3% as a down payment. Now, on the FHA side, the requirements are a little bit higher, and they require a 3.5%. Regarding credit, on the conventional side, they require you to have a minimum FICO of 620. But then on the FHA side, the requirements are a little bit more flexible, and you can actually get into the program with a FICO of 580. However, you can go even lower if you put a down payment of 10% or above. And when you do that, you can actually get into the program with a minimum FICO of 500. So everything seems great so far, but here's where things get interesting. These mortgages have a limit in terms of how much money you can get. Let me show you. So on the conventional side, you get a limit of generally, right? So for most areas, so we're gonna write here generally, of $647,200. That's the maximum amount you're gonna be able to get on a loan for you to buy a house. However, if you reside or you're looking to buy in an area where the cost of living is high, so let's say, for example, New York City, San Francisco, or even LA, the limits can be a bit higher. And in this case, you have a maximum limit of $970,800 for single family homes in high cost areas. This means that if you saw one of those beautiful houses for $1.5 million, you have to forget about buying it with a 3% down payment because you would just simply not qualify. Now, on the FHA side, the limits are actually lower for general areas, so to speak, right? So the maximum amount that an FHA loan can give you is $420,680. Now, if you happen to live in an area where the cost of living is quite high, so let's say, for example, New York, San Francisco, LA, the limit is actually the same for those type of areas. Now, I want to highlight something. These limits that you see here, these are according to 2022 numbers. Depending on when you're actually watching this episode, you might want to look into the program to see if they have increased the limit. But as of the moment of this episode recording, these are the numbers. So back to the tablet, we got these numbers right here, and little by little, we're seeing that the reality is different. There is some flexibilities for some things, but there are restrictions for others. Now, let's continue down the list and let's talk about insurance, right? So on the conventional side, because of the fact that you're paying a down payment less than 20%, in this case 3%, the mortgage company is going to require you to buy an additional insurance called PMI, okay? And this PMI stands for Private Mortgage Insurance. And this type of insurance is not to be confused with the insurance of your property. So these are two different types of insurance. You're buying insurance to protect your property, and now you're buying an extra insurance, the PMI, to protect the bank for the difference that you're not putting down as a down payment. And this means that your monthly mortgage payments are actually going to be higher. So let's run the numbers with a mortgage that requires a 20% down, right? So for the most part, those mortgages will look like this. So there's the principal that you're paying on a monthly basis. That's, let's say, $300. And now we're going to talk about interest, also a very arbitrary number, $700. And we also have escrow, right? And that's insurance and taxes. And we have, let's say, $500. So when you add all of these numbers up, we're talking about $1,500 a month, right? That's under a regular circumstance. But let's say that because you decided to go for a low down payment program, now you need to add the PMI into the equation, right? And let's say that that's an additional $100 a month, bringing your monthly mortgage costs up to $1,600 a month. So now you get to see how things are. Banks are telling you that you can buy a house with only 3% down, but later you realize that you have to pay more on your monthly mortgage payments. Well, the good news is that this PMI is not forever, and we will cover that in a little bit. Now, back to the tablet to talk about the FHA side of things. We have a similar insurance, but this is going to go with a different name, MIP, which stands for Mortgage Insurance Premium. I know, very creative, right? So this MIP is somewhat similar to the PMI that you see here on the left side, but it is not the same. It is similar in the sense that this MIP is insurance for the mortgage and not for your home. And this means that you also have an additional cost. It is not similar because this MIP has two stages. One is when you pay for this MIP at closing, right? So you pay for a one-time fee, and then you're gonna have to pay this MIP again on a monthly basis. And that means that under these circumstances, the FHA becomes a more expensive option on a monthly basis. One, because you have to pay for the MIP when you close, and also because you have to keep paying it on a monthly basis. Now, I have good news. The PMI under your conventional mortgage can be removed once you build up 20% of equity in your home, lowering your monthly mortgage payments. Let me show you how this works. So you have this house right here that you bought, and because you put down 3% for your down payment, this is how much equity you have, right? But then over time, you're going to keep paying down that mortgage, you're going to keep building up equity, and your payments, it's going to make the debt smaller and making you a little bit richer in terms of equity. So let's say at this point, fast forward a couple of years, you have already accumulated 21% in equity. At this point, you can actually contact the bank and ask them to remove your PMI out of it. Although legally they're supposed to remove it on their own, but sometimes, they need a bit of a reminder, so you have to reach out to them and tell them to please remove it. Now, I want to pause for a second and ask for your opinion. What do you think about what I'm sharing so far? Let me know down in the comment section below, and your comment will help me get to know you better, so that way I can design a much better episode that can meet your needs in terms of what you're looking to learn. Now, back to the episode. Now, sadly, on this side, on the FHA, things are a little bit different because the MIP will never be removed. However, there is one thing you can do at the beginning to shorten that requirement, and that is putting 10% down or more in your down payment. This 10% right here or more will actually reduce your MIP requirements down to 11 years instead of 15 or 30 years, whatever the length of your mortgage is. So you see, these right here are the details that banks don't openly talk about or just simply don't explain well. Now, as for the rest of these mortgages, these are similar in the sense that their term, I would say it's about the same. So we're talking about 8 to 30 years. While on the FHA side, we're talking about 15 to 30 years, right? So now, in terms of interest, I will say that both programs offer very competitive rates because they're both backed by a certain institution. So on the conventional side, we got Freddie Mac and Fannie Mae. And then on the FHA side here on the right, we're talking about the Federal Housing Administration. Now, in terms of type of interest, I will say they offer just about the same. So they have fixed rates and they also have variable rates. And same on the FHA side, only they call it a little bit different. They call it fixed and then adjustable.